Let's talk about compound interest versus simple interest. So, when you see somebody on the internet talking about using leveraging credit cards or leveraging a line of credit to help you to pay off your mortgage or putting your home in a HELOC versus a regular mortgage. And some people might express it as if you're using a HELOC, that's simple interest, but if you have a regular mortgage, that's compound interest. Okay? Not true. Not true at all. Mortgages do not use compound interest. Compound interest means that when you get interest on your earnings, let's say you have an investment, all right, or you have an insurance policy that pays you dividends. So when you receive those interest payments, they become part of your principal. And now the company that's paying you interest starting to pay you interest on your interest. That's the compounding effect of compound interest, getting interest payments on your interest. Mortgages don't work that way. You pay interest on the unpaid balance for 360 months. That's an amortized interest loan. So it's amortized interest. Okay? Now, here is what we're talking about. I don't care what kind of loan that you have, whether it's a credit card, whether it's a home equity line of credit, or conventional mortgage or FHA mortgage. They're all amortized interest, all of them. Some of them have different rules. So how a mortgage works, when you get your mortgage, okay? When you get your mortgage, how does that work? How are we looking at that? Okay? When you get your mortgage, here's what's happening. You are paying interest on the unpaid balance. And while you're bringing down the principal bit by bit, you're paying interest on the unpaid balance. That's why it's so expensive. All right? So that's amortized interest. It's not compounding interest. But you're charged the interest on a mortgage monthly. You only pay daily interest 2 times during a mortgage. Once before the first payment, and when you call to find out what is my payoff. I want to pay off the entire rest of my balance. Then they will give you a payoff that is good until a certain date. And they figure daily interest there. That's the only time your mortgage figures daily interest. 2 times, at the beginning and at the end. Now, even though the other loans that I mentioned are amortized and not compounded, what they do is on a line of credit, you pay interest on the average daily balance. But it's still based on an amortization schedule. But they do start charging daily interest, and then they average out the daily interest so that you will pay interest charges based on the average daily balance. That's the difference between your credit card, your line of credit, and your mortgage. They're both amortized. It is not simple interest versus compounded interest, because compounding doesn't exist when it comes to mortgages and other loans in the first place. So let's get rid of that. So has that myth been sufficiently busted here today? Folks, here's what I'm talking about. If you knew this stuff, you'd be much further ahead, because you're not in the financial position you're in because you've been irresponsible with your money. Most of us are in the financial position we're in is because we followed the advice of so-called experts for years. And we didn't know how it was hurting us. And I'm here to tell you, it's not your fault. It's not. How could it be? It wasn't because you weren't paying attention in class. It was because there was no class. There's no class on this. It's only here. Why? Not because how smart I am, but because how my brain is wired when I see things other people don't. That is a total gift. I can't even take credit for that. For some reason, God chose to wire my brain this way so that when I look at an amortization schedule, I just see things differently. And now I'm sharing it with you. How about that? So if you want to know more about what we do, you want to know how we do this, if you want to know more about it, then get a savings and earnings report today. Go to my website, pillmethod.com, and start learning this information for yourself. And most importantly, if you have kids, if you have grandkids, if you have nieces and nephews, if you have young people in your life at all, you can start teaching this to them. Now, I've given you a gift. Go out and give it freely. You have received, the Bible says, freely give. So we're giving it out. All right? So, but in the meantime, guess what? I read another book that talked about the go-giver. All right. And in that book, it says, your income will be determined by how many people you serve and how well you serve them. If you serve people well, they will pay you for what you know, for the value you provide. Lady Miz knows that to be true. Lady Miz says, I'm providing value. She says, listen, I even got my own chip company. She's got her own snack food company. People pay her for the value she provides. Some of you have businesses in here. People pay you for the value you provide. Here's what I'm saying. Provide more value than you ever take in money. People appreciate it and will tell others. They'll be your biggest cheerleaders. So folks, go and get your savings and earnings report right now. Fill out the information, follow all of the instructions, and someone from my office will get with you within 48 hours of you submitting your financial data. And here's what you're going to know. The month, day, and year you're going to be debt free. How much interest you can save. And then we're going to show you that interest savings, how much money you could possibly earn for you and your family by not giving it to the bank and taking advantage of compound interest.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.